In light of Friday's sobering jobs report, Michael Aronstein joins me on set to help delve deeper into the linkage between the U.S. economy and markets. Michael is the president of Marketfield Asset Management. It's a great performing fund. Great to have you here.
Hi, pleasure.
Good to see you again.
Likewise.
I'm curious because when we often talk to you, you always find some optimism in the market here. We've had, 5 down weeks. We had about 6 down days. A little bit of optimism today. Where are you in terms of your market outlook right now?
Well, I'm still sort of friendly toward the United States and concerned about the rest of the world, which is that's very different from the trend that's been in place for the last 10 years, where you really, the more money you could have gotten outside of our borders, the better, for the most part. But I think we're at a juncture where that is beginning, that long trend of superior performance in non-dollar assets is going to begin to reverse. And the reversal process is tedious. It's a slow process, but I think you're going to start seeing some signs that the rest of the world, particularly the EM and most notably China and India, are going to disappoint people.
What's the impact then on the U.S. markets? You wrote a lot about emerging markets in one of your latest notes. It kind of surprised me. Mike, what's the impact then on the U.S. trade? I mean, the U.S. market plays a lot, certainly, into China.
You're starting to see it.
Is that the unraveling that we've seen then as of late? Yeah,
I think some of the sectors that really performed the best since the lows of last summer, right up until the end of the first quarter, machinery, some of the export-oriented companies, kind of the U.S. and Western European companies that have been leveraged to global growth have performed quite poorly. See some of the big Korean exporters not doing well at all, which is a big change.
We've got a chart up. This is the JP Morgan Emerging Markets Bond Fund. So looking at what we've been seeing in terms of performance, that tells you what?
Well, the money has kind of retreated from solely equity-oriented flows, and now that's been the most popular asset class worldwide over the past 6 months. No.
Don't?
I'd be very, very careful about emerging market bonds at this juncture. You're starting to see pressure in the whole high-yield sector in the United States, right across the board, and the same is true
after a nice run.
Yeah, it's been a great place to have money since the lows in 2008. It's been fantastic, but you're starting to see some movement away there, and I think the emerging market bonds are just another form of high yield, but I think the confidence level surrounding investors in that is too high, and that would create some risk.
How much risk? And, I hate to say bubble because I feel like it's inflammatory a little bit. But, I mean, how much? We have Jim Chanos, who came on a few weeks ago, and he had a crew over in China for about 3 weeks, and they came back and said, we're not bearish enough on Chinese real estate. How bad is it, potentially, in your view?
Well, for a U.S. investor, the real problem is the liquidity gate that's caused by the currency. Either investing in non-dollar bonds overseas, in which case you have the foreign exchange effect directly, or investing in companies who are non-U.S. who are issuing dollar bonds, and then they have to get their hands on the dollars in order to satisfy the obligations. So you could get a generalized retreat or an attempted retreat from the asset class, and you might have a very small window of liquidity through which the retreat proceeds, and that would be dangerous. You could get This is one of the few processes in the capital markets at this point that has the potential to become disorderly.
You're talking a lot about emerging markets. I'm hearing a lot about China. What about Europe at this point? We heard from Jean-Claude Trichet today talking about the prospect potentially of maybe some higher rates here and inflationary concerns, pricing pressure. Where does Europe factor in to your macro outlook at this point?
Europe is part and parcel of the process where you're seeing the quasi-emerging market portions of Europe beginning to, or they're continuing to unravel. And I think it's not
getting better, is it?
No, and it's not going to. I mean, Greece is in the process of a restructuring, and how that is going to proceed has become a political question. It's no longer financial or economic, but you're starting to see the performance certainly out of the European periphery in terms of contribution to the overall economic tone is really, it's weakening pretty rapidly.
All right, so help me out here, because like I said, you usually have you have some optimism for me. You do like the U.S. market more, and we'll talk a little bit more specifically maybe in the next block about that. But I mean, when you look globally, are things getting a little bit ugly here?
Yeah, I think people have. We've had a trend in place where for the past 10 years, or 9 in most cases, it's been almost a no-lose situation to have most of your assets in emerging markets.
Right.
And when it started, people consider the concept of investing in emerging markets following the U.S. bear market of 01, 02. People thought it was absolutely ridiculous to take those risks on the heels of what, up until recently, was a really disturbing bear market in U.S. growth stocks. The idea that you should have a substantial proportion of your assets in what then were considered the riskiest corners of the globe was outlandish to people.
Right.
Now it's sort of, a man on the street can tell you, oh yeah, China, movement to cities, expanding middle class.
Yeah, but that makes me a little nervous.
It makes me very nervous because I think it's precluding people from actually going in and doing the work. And I think the basis for the growth in these areas, particularly China, initially was very, very sound fundamentally. You had the whole Western manufacturing base relocated to the EM and particularly into China. So you had a tremendous influx of capital, which was a real productive capital formation.
Right.
Now it's become a flow story.
They're going through a real transition. There's no doubt about it.
They're going to try, and I have never seen an authoritarian state go through it smoothly, even reading back hundreds and hundreds and hundreds of years.
History tells us a different story. Mike, I want to kick it off with Sheila Bair. She was at the Council of Foreign Relations in New York today and had something to say about the 10% capital requirements being talked about for banks. Listen up, everybody.
They're still going to be able to make a nice return on equity at 10%. And, there's going to be some trade-offs. There may be some new normals. But with a higher capital requirement, shareholders are going to have less risk in their investment as well.
So she's saying less risk for shareholders, but she said that banks are still going to make a nice return on equity. Financials, have been a dog this year, the worst performing kind of major group in the S&P 500. What do you think about the outlook for financials? It's going to be different.
We're still short the stocks. We've been for a long time. I think the integrated one-stop financial supermarket is it's a model whose time has come and gone.
So what does that mean then, Mike, for the J.P. Morgans of this world, for the Citigroups of this world? Do we start to see them being broken apart, or what?
I'm not sure whether they will intentionally break apart or whether their good people will just emigrate into more rational business units where they have control over their own destiny and really don't have to put up with the regulatory scrutiny and the whole. Being part of an industry that's in what I believe is a long-term decline is not a pleasant way to.
A long-term decline.
Yeah, I think the big financial service companies are kind of where the U.S. auto industry was 35 years ago. So
then do you agree with Jamie Dimon when he questioned Ben Bernanke this week, kind of saying, has anybody done a study, looked at all these changes that are happening to the financial industry, all the requirements that are potentially being asked of it, reserve requirements changes, the impact that it's going to have on financials?
Well, nobody knows about that specifically, but they are built and they have sized the cost side for a world that has passed, a world in which pretty much unlimited use of leverage and in some instances really mixing the customer business with the proprietary business to the detriment of the customer. That's going to become much, much more difficult.
So things have really changed.
Oh, I think they've changed enormously in that business, and but it's a very, very long process. It reminds me, in 1961, the electric utility index in the United States traded at 23 times earnings. Now, 20 years later, in 1981, they were basically almost all out of business.
Okay.
And they were considered low-quality bond substitutes.
Are you going to say all these guys are going to go out of business, the financials?
Oh, no. But the businesses are just going to look a lot different in 10, 15, 20 years.
So Jamie's right to be a bit concerned here.
Well, I think he's attacking it from the wrong standpoint. But what else is he going to do? He's lashed to the mast.
Yeah, he is. That's so true. Hey, listen, I would be remiss not to ask you about commodities. You've had great calls on commodities in the past. Oil's up today. We've seen some pullback, though, in commodities as of late. What do you think the outlook is for commodities, Mike?
I still think if this whole story about global growth being pulled by the build out of the emerging markets,
Goes back to your emerging market story.
if that comes into question, I think the flows will start to change. The other thing is the dollar, and I've been dead wrong about the dollar. I've been positive about it all year, and,
right.
and it's really done nothing. But I still do think that fundamentally the U.S. is too cheap. New York is now the 26th most expensive city in the world to do business in, and that's. And 26 is a pretty low number for New York City when you look at some of the cities that are above it. And I think that's just a function of the flows into financial assets elsewhere that's really distorted the exchange rate picture.
We got to run. Mike, thank you so much. We appreciate it.
Very
Mike
welcome.
Aronstein of Marketfield Asset Management.